So, a single social media post recently promised to use a massive $200 billion fund to lower mortgage payments for millions of Americans. But can it actually work? Let's unpack this whole plan.
It all started right here with this post on Truth Social. On January 8th, President Trump announced that he was ordering a massive purchase of mortgage bonds. The goal, he said, was to directly drive down mortgage rates and, those painful monthly payments for millions of Americans.
But, a directive like this, it raises a ton of questions. How would it even work? Who has the authority to actually do it? And would it even have the effect that's being promised? So in this explainer, we're going to unpack what we know and what's still pretty uncertain based on all the reporting around this statement.
Okay, so first things first. Let's look at the numbers and the stated reason behind this plan. I mean, where is all this money supposed to be coming from, and what exactly is it meant to do?
Well, the sheer scale of this is, wow, $200 billion. Now, according to the president's post, this isn't about new spending. The idea is that the money would come from cash that's already being held by the mortgage giants, Fannie Mae and Freddie Mac, a sum he called an absolute fortune.
So the plan is to take that cash and buy mortgage bonds. And what are those? Well, you can think of them as these big bundles of home loans that investors buy and sell. The core idea here is really just basic supply and demand. If a massive new buyer, say the government, starts buying up all these bonds, it drives their price up. And when bond prices go up, the interest rates tied to them tend to go down.
And let's be really clear about the stated goal here. This isn't just some abstract financial maneuver. No, it's aimed squarely at a huge political issue, housing affordability. The entire justification for this whole thing rests on that promise of lower rates and, ultimately, relief for homeowners.
Okay, but this brings us to a major question mark in the whole plan. The president's post was, well, a little vague. He said he was instructing my representatives to make the purchase. But who does that actually mean?
And this is a really critical question, right? The Post didn't clearly name which government entity would be in charge of spending this $200 billion. And as you know, in Washington, knowing who's in charge of the money, well, that's everything.
So analysts are pointing to a few different possibilities. Could it be Fannie Mae and Freddie Mac themselves? Maybe the Treasury Department? The answer really matters because each of these organizations operates under totally different rules, with very different powers and limitations.
Now, we did get a little bit of clarity later on from Bill Pulte. He's the director of the agency that oversees Fannie and Freddie. He responded on X, saying that yes, those two entities would be the ones to carry out the plan. But, this is still a response on social media, not some formal government directive.
So how is this all supposed to work, really? I mean, the government getting involved in the bond market isn't new, but the authority to command it, that's a critical detail. So let's take a look at what's been done before.
And the analysis here draws a really crucial distinction. You've got the Federal Reserve, which often buys bonds as part of something called quantitative easing, but that's a policy meant to juice the entire economy. Plus, the Fed is independent. It can't be ordered around by the White House. Then you have the Treasury Department. It does answer to the president, and it has bought mortgage bonds before, but that was only during a massive crisis, like the 2008 financial meltdown.
Okay, this brings us to how your mortgage rate is usually set in the first place. See, the interest rate on a 30-year mortgage doesn't just exist in a vacuum. It's almost always tied to the rate on a 10-year Treasury bond. Because lending money to the U.S. government is seen as super safe, that Treasury rate becomes the benchmark for pretty much all other lending, including mortgages.
So all of this leads to the most critical question of all, the one homeowners and investors are all asking. Would this specific plan actually work the way it's supposed to?
And this is where the plan might hit a snag. Remember what we just said. Mortgage rates tend to follow Treasury rates. So according to the analysis, just buying up a ton of mortgage bonds might not actually have a strong direct impact on those all-important Treasury rates. It's kind of like trying to lower the temperature of a whole lake by just pouring a single bucket of ice into one little corner.
So if we look back, it helps us see that even though government bond buying isn't new, the context and the authority for this plan are really different. The Treasury's action in '08 was a crisis response. The Fed's actions are broad monetary policy. This new proposal is a very targeted directive from the executive branch, happening in a time that's not really considered extreme turmoil.
Finally, we absolutely have to place this announcement within its political context. Because let's be honest, this wasn't just an economic statement.
The announcement came wrapped in some pretty sharp criticism of the previous administration. The Post explicitly claimed that his predecessor had ignored the housing market, and he linked the whole affordability problem directly to past policy failures.
So, when you boil it down, this directive is being presented as more than just a policy idea. It's being framed as a decisive corrective action. The message is pretty clear. There was a problem, and this is the fix. And that makes this as much about political messaging as it is about market mechanics.
So to recap, while the directive to buy $200 billion in bonds is really clear, the authority to do it, the exact mechanism for how it would work, and its likely effectiveness, well, those all remain big open questions according to the source material. We're still waiting on some pretty critical details.
So a very ambitious promise has been made. But with the authority unclear and the economic impact uncertain, the market is kind of left to wonder. Is this a real policy shift that's going to affect millions of homeowners? Or is it a powerful piece of political theater? I guess the answer will really depend on whether this $200 billion directive ever becomes more than just a post on social media.